Joining us is Josh Friedman, Canyon Partners co-founder and co-CEO. Josh, it's great to have you.
Thank you very much, Sarah.
Welcome.
Thank you for having me.
So I know you're sort of known as a distressed investor, so maybe you're licking your chops, but I'm just curious where you think we are in this whole process of completely revaluing equities and bonds and crypto and everything else as the Fed raises interest rates and we deal with this war in Ukraine and the shutdowns in China. How much longer do you think this volatility lasts?
I think we had a pretty big sea change in the environment generally in the market. We went from a market that I would call a negative optionality market to a positive optionality market. And what I mean by that is if you bought a bond prior to a few weeks ago, there had been so much pressure from the Fed and the Treasury stimulating the market on top of the demand that was naturally recovering from COVID, that rates were so low and demand was so high that everything was pouring into equities. And on the debt side, yields were so low. So if you bought a standard bond, you were negative optionality. In other words, if rates went up, you lost money. If credit spreads went up, you lost money. If the credit deteriorated, you lost money. We have seen a sea change in that psychology over the last 2 weeks.
Is it healthy to you, as someone who did warn about the excessive risk-taking that we saw during that period?
Absolutely. I think we're starting to see a return to things like actual financial covenants. We're seeing bonds that we and others passed on that were trading at par or were purchased by brokers at par a few months ago that are now trading at 90, 88, 86. There's been a little bit of liquidity withdrawn from the market, but I don't think the banks are in such poor shape that we're likely to see the kind of liquidity crisis that will drop prices really dramatically. And you also have quite a lot of private capital running around chasing credit securities. But you have seen drops, and it is much, much more balanced in terms of the type of return per unit of risk for an investor in the credit area.
So what do you do, Josh? Because it's been painful to be in stocks and bonds this year.
Well, the types of strategies you pursue in a negative optionality environment are quite different from what you do in a positive optionality environment. So prior to this change, the focus is more on short duration, event-driven situations, private situations where you could negotiate extraordinarily strong covenants because an issuer needed capital quickly and it couldn't be addressed by the public markets because it was either confidential or competitive, situations that were more arbitrage and event-driven, things that really weren't likely to move with the market. All that changes when you get into this type of an environment and you start looking at all of the things that maybe passed over your desk and weren't interesting 6 months ago, but were maybe you start with the strongest credits, the highest quality things that were just priced too tight. And now maybe a broker has to unload some inventory he has, or there's a buyer who's leveraged who has to sell. And those are the first things that drop in price and become attractive. We're still a little bit away. You mentioned distressed. I think we're still a little bit away from seeing things that are at that low a level of the capitalization as to be distressed and to be interesting. We'll be waiting a little while for those.
But are you guys actively buying bonds here?
Yes, we are, but we're nibbling. So I wouldn't say that we're in with both feet. 5 million here, 25 million there, 15 there, things that we already know where we can react quickly before a lot of attention is drawn to those particular securities. But yes, we've seen things down, as I said, 10 to 15 points from where they were. And at these levels, they start offering returns that look more like mid-teens to high teens as opposed to single digits with a lot of ways to lose money.